client recently asked me for my thoughts on reverse mortgages. The topic of reverse mortgages can bring up strong feelings and troubling stories of family members who took out a reverse mortgage and had a bad financial outcome. But like many financial products, reverse mortgages are simply a tool. They can do a lot of damage in situations where they're used incorrectly, and they can be a great solution for a retiree who meets a number of important criteria. In today's video, I'm going to briefly explain what a reverse mortgage is. I'm going to talk about how it differs from other lending products. We'll talk about the pros and cons of the reverse mortgage. We'll talk about some situations where it can be used improperly and create conflict and disappointment. And I'll also outline a scenario where I think a reverse mortgage could be a very elegant solution for a specific type of retiree. And if we haven't met yet, my name is Mark Walhout, and I created this channel to share ideas and concepts that I'm using to help people with retirement every day. If you want to get more videos like these, consider subscribing to the channel and hit the bell icon so that you're alerted when new videos are posted. So we'll start with a very brief overview of what a reverse mortgage is and how it differs from other lending products. So basically, a reverse mortgage is a lending product that allows a homeowner who's over the age of 55 to take out a loan for up to 50% of the value of their home, assuming that that home is paid for. Funds from a reverse mortgage can be taken as a lump sum. They can be taken as a monthly income from the reverse mortgage, or some combination of the two. Reverse mortgages do differ from more traditional financial products like lines of credit and regular mortgages in that the reverse mortgage is a lifetime loan. There is no fixed repayment schedule for a reverse mortgage. There are actually no payments required at all on an amount borrowed from a reverse mortgage. Principal and interest on the loan are not payable on that loan until the homeowner either moves out of the property or they pass away. If the loan on the reverse mortgage plus the interest that's accrued on that loan exceeds the proceeds of the house sale of the home that the loan is secured against, the lender is on the hook for the difference. And this is very unique from other more traditional home lending products like mortgages and lines of credit. So use, for example, a scenario where a reverse mortgage is taken out on a property, 20 years pass, and the accumulated interest and principal on the loan now exceed the fair market value of the loan. Once that estate is settled, if there is an amount still owing on the loan that was taken out, the reverse mortgage, then it's the lender that would be on the hook, not the estate of the deceased. And finally, a reverse mortgage loan is not callable by the financial institution. So unless you move or you pass away, the reverse mortgage lender cannot ask you to repay the loan. And this is different from something like a line of credit, which is callable by the financial institution if your financial situation deteriorates or if the lender decides to make a call on that loan. Now let's spend some time talking about the pros and cons of reverse mortgages. And we'll start with the pros. Reverse mortgages require no income verification. So if you were to go to the bank today and ask for a traditional mortgage or a line of credit, the lender is going to require that you provide proof of income because you're going to be expected to repay that loan during the life of the loan. But because the reverse mortgage doesn't have a fixed repayment schedule, you don't need income to be able to prove that you qualify. You will need to meet other criteria in order to qualify for the reverse mortgage, but having income and verification of your income is not going to be one of those criteria. The second pro of the reverse mortgage is it requires no repayment during your lifetime, and it's not callable like a line of credit. It's a more permanent lending solution. You do not need to have additional cash flow that you're going to need to free up in order to service that loan during its time frame, and the lender does not have the right to call back that loan. So people who are in a situation where they're needing extra cash flow or they need extra lump sum cash from a reverse mortgage, it will be tricky for them to come up with free cash flow to service debt. So this is a definite pro on the side of reverse mortgages, that they have no requirement for repayment during your lifetime. The third pro of reverse mortgages, and this is actually true of any lending product against your home, is that reverse mortgage payments are considered tax-free. So it would not disrupt any income-tested social benefits that the recipient might be getting, such as old age security, guaranteed income supplement, certain tax credits that are income-tested like the age credit. Money that you take from your reverse mortgage is not going to be added to your income. So those benefits are tax-free. And another pro of the reverse mortgage is that its presence may allow a client to stay in their home, and they may not otherwise be able to achieve that through a different type of lending product. So you can sort of unlock the equity in your home, be able to consume some of that value without having to sell your property in your lifetime. Some of the cons of reverse mortgage, really the big one is the higher cost of the product when compared with other lending products. So I checked 5-year rates for regular traditional mortgages, posted and available online. Current 5-year fixed mortgage rates are hovering somewhere between 4.3% and 4.85% as of the day that I'm recording recording and posting this video. When you compare those to the reverse mortgage rates that are available today, 5-year fixed rates on reverse mortgages are somewhere between 6.69% and 7.75%. Over the past several years, this is pretty common. There's about a 2% per year spread between traditional mortgage prices and reverse mortgage prices. There are also legal and setup fees that need to be added to this cost. So the higher cost of the mortgage product is definitely a big con, but sort of going back to the earlier part of the video, because the lender takes on the additional risk of a negative equity position if the house is sold eventually and there's not enough money to cover the cost of the loan, plus the fact that there's going to be no repayment of the loan during the homeowner's lifetime. There are features that the homeowner is paying for embedded in this higher interest rate with reverse mortgages, which sort of explain why there's such a discrepancy between the prices of these two products. Now let's spend some time talking about situations where reverse mortgages can be used improperly. And these are the heartbreak stories that I do hear from people where they realize that a family member entered into one and now they're in a situation where they're in a tight financial spot. And the best kind of broad description of these scenarios is where people take the reverse mortgage too early to supplement lifestyle wants. And then when home equity is eventually needed down the road, when the retiree is in their 80s and 90s, they need that home equity value to supplement healthcare needs, but there just simply is not enough equity left in the home after subtracting out the value of the reverse mortgage. So we'll use a very simple example of a reverse mortgage. Let's say a retiree has a home that's worth $1 million. They take out a $250,000 lump sum reverse mortgage and they make no repayments against that mortgage. The mortgage carries a 7% annual interest rate. After 10 years with no repayments, the balance on that reverse mortgage is $500,000. And after 20 years, the balance on that reverse mortgage is about $1 million. After 20 years of retirement, now the retiree is in a situation where they have a major health event and they need more money. There may not be enough home equity there once the house is sold and the reverse mortgage is paid off to be able to address the need that the retiree has at that time. And this is where I believe a lot of the heartbreak around reverse mortgages occurs. It's where people take too much in a reverse mortgage. They take it too soon in their retirement. The loan value grows tremendously. And then later when more money is needed, the family member, the homeowner, expresses shock and surprise that they have so little left after paying that reverse mortgage. And more than anything else, I believe there's a big communication issue here. In many situations, I don't know how much the homeowner is communicating with their loved ones that they have taken out a reverse mortgage. So oftentimes it's family members kind of sitting over an estate discussion, sitting there with the will, with the executor settling the affairs of the deceased and realizing that they thought that they were going to be inheriting a home. And really what they've inherited is a home minus this huge reverse mortgage balance, and that creates a lot of frustration, a lot of shock, and I think that's where a lot of the anger around reverse mortgages sort of comes into play in the general public. Now we'll close with a situation where I believe a reverse mortgage could be a very elegant solution for a certain retiree. So we're going to picture a retiree or a retiree couple that's in their late 70s or 80s, so they're approaching sort of the later phases of their retirement. They're beginning to run low on liquid savings, and more than anything else, the senior retiree wants to live in their home and stay in their home. So they decide that they would like to take out a reverse mortgage to supplement lifestyle needs, such as getting care provided to them in their home, renovations to their property for accessibility, maybe adding a ramp or an escalator in their stairwell, getting regular maintenance and upkeep help around the property. These are all really good reasons to get a reverse mortgage, and I think that somebody in this scenario fitting this fact pattern is probably a good candidate for a reverse mortgage product. But the big key with this type of solution is that the homeowner, that the retiree is clear in their intentions and hopefully speaking with their family and loved ones about what they're doing and bringing them into the discussion. It is sensitive, of course, to share financial affairs with loved ones and with family members, but from the really bad stories that I have heard about people with reverse mortgages and people who have family members who've had a tough time with reverse mortgages is when the family is totally shocked and surprised at sort of the state of the deceased parent's affairs after they're gone and they're settling the estate and they realize that this reverse mortgage was in existence. It is tricky stuff, but if I was entering into a reverse mortgage, I'm sort of making this now personal, it's about me. Down the road, I believe that I would explain that to my family, to my loved ones, just so that they were not going to be shocked later. Express my desire that I do want to live in my home and I want to stay here through the balance of my life. And I'm doing this in order to make that happen and that it will have an impact on their net estate. And hopefully that sort of clears up any potential frustration, potential ill feelings towards the strategy and toward the intention to to do that. So thanks for watching this video all the way to the end. I hope that you've enjoyed it. Please, if you like it, give it a thumbs up. Consider subscribing to the channel. Leave your questions and comments below. Thanks for watching, and I'll speak with you soon. Take care.